So that day we did. This is the Wilson Company question. Once again, you can see this question. So we finished till this. We finished till the income statement. Fine. And we found out the like statement with the net profit for the year. Now we will find out the gain on property revaluation. Just check this adjustment. Okay. Now let me give you some information regarding this. As you already know, gain on property revaluation is nothing but unrealized nature income. It's a unrealized nature income. How will you find out the gain on property revaluation? Let's see the information in the question. See, the property here there is a adjustment. The property was acquired some years ago. The building's element of the cost was estimated at $100,000 and the estimated useful life of asset was 50 years at the time of purchase. As at 31st December, the property is to be revalued at $800,000. So the property is revalued at $800,000. This is the revalued value. Okay. Now, what is like, see, revaluation, like they revalued the property to this. Let us see what was the actual carrying amount of this asset. Carrying amount is nothing but book value, the value which you show in the books. Okay. Book value. We say this as carrying amount. Just a second. We say this as carrying amount. Now let's see what is the carrying amount of this. So there we go. For that, we have to see the balance sheet. You can see here, land and buildings. The cost is clearly given to you as 430. This is the land and buildings. Okay. Now we will see whether they have some accumulated depreciation or not. What do you mean by accumulated depreciation? See, accumulated depreciation is the depreciation which is nothing, which it is such an account which has the depreciation of the asset till date. That means, let's say the asset, let's say the asset has been purchased 5 years ago. Asset has been purchased 5 years ago. So this is the suppose let's say the asset is of $100,000. I'm giving an example. This is another example. And the rate of depreciation is at the rate of 10%. If I ask you after 5 years, what will be the value of asset? You'll say $50,000. How? Every year 10,000 will be deducted from this from this $100,000. Correct? So now if I ask you what is the, so this is the $100,000 is the asset value. This is like like it is like $50,000 after 5 years, because every year $10,000 has been deducted. So this $10,000 which has been deducted every year has this particularly goes into an account called accumulated depreciation account. So this is accumulated depreciation account. This is first year's depreciation gone in this account. Second year's gone in this account. Third year's gone in this account. Fourth year's gone in this account. Fifth year gone in this account. And now in 5 years, how much is the amount in accumulated depreciation account? $50,000. So this got deducted from the asset value, and this is the assets carrying amount right now. What is that? Carrying amount. Yes, Bishara, did you understand? Abhishek, did you understand? Hello.
Sir, I haven't understand, sir. Can you repeat it again, sir, if you don't mind?
See, this is the asset value and it is getting depreciated every year. And the rate of depreciation is 10%. So every year, 10% of this asset value, which is $100,000, okay, would be deducted from that asset as a depreciation. If you have studied BCom, you would be better knowing. So now $10,000 first year depreciation, second year depreciation 10,000, third year depreciation 10,000, fourth year depreciation 10,000, fifth year depreciation 10,000. But what is happening? This all every year depreciation is getting is like transferred to an account called accumulated depreciation account. Now, how much is the accumulated depreciation of 5 years in this account? How much is the value? 50,000. That 50,000 will be deducted from the asset, and now the asset value is how much? 50,000. So after 5 years, every year's 10,000 has been deducted, and now the asset value is 50,000. This is called book value or carrying amount. Okay. Now is it clear, Abhishek?
Yes, sir.
Yes. And Bisharo, is it clear to you?
Yes, sir.
Yeah. So now see, this is cost. This is the land and buildings here given. Now what we'll do is we will remove the accumulated depreciation account, accumulated depreciation from this. So accumulated depreciation of buildings is 20. So let's remove that from it. So now it is 410. Why I am removing the accumulated depreciation? Because that much the asset has got depreciated, because here in the bracket you can see this is cost. When they give you the asset value in the balance sheet and they write something in the bracket as cost, that means this is the original cost of the asset, and the asset has depreciated by 20, and 3 zeros omitted here, $20,000. Okay, so that you have to remove, and this is your assets exact value right now. But one thing we know in adjustment, see, adjustment is very clear. Here you can see the property is nothing but a part of land and buildings. The property was acquired some years ago. The buildings element of the cost was estimated as $100,000, and so building, so this $100,000 worth of building, okay, has a life of 50 years. Now this is a part of that land and buildings. This property which you are seeing here, which was acquired some years ago, okay, is a part of land and buildings. But the depreciation what it has undergone, or its depreciation, is different from what they are giving. See, accumulated depreciation, that too you can see the date. Here it's very important, just understand what I'm saying. The accountant of Wilson Company has prepared the following list of account balances as at 31st December 2007. That means this is 2007's data, and they are asking you to do what actually? Prepare the financial statements of Wilson Company as on 31st December 2007. Okay, so this is what they're asking you. So till that time, the accumulated depreciation account is showing how much, and you should see, see, I am saying you, dates are very important. This is the land and buildings as on 1st 2007, the beginning of the year. Okay, the beginning of the year. See, you have to prepare balance sheet or statement of profit or loss for 31st December. But this land and building value has been given for Jan 1st, 2007. And you have to prepare the balance sheet for 31st December 2007. Now, plant and machinery also, it is like beginning of the year. And here, the accumulated depreciation is 1/1/2007. That means this is also the beginning of the year. So now, since this is beginning of the year, the end of the year would come, and that time your accumulated depreciation balance of this would be something different. Okay, how it would be different, I will explain you. Because this current year's depreciation of the asset would also be transferred to accumulated depreciation account. See, which depreciation would be transferred? Now let's see here. The buildings element of the cost was estimated at $100,000, and the estimated useful life of asset was 50 years. So now what is the depreciation of this building? We will take $100,000 and we will divide by 50 years. We get 2,000 every year. That means 3 zeros omitted, 2. So this is the current year depreciation of building, okay, which should be deducted from the building. So what I'll do is I'll just deduct the depreciation part minus 2. That is the depreciation. Now, can you tell me it is how much value? 408. And this building, which is of value 408, has been revalued. How much? It has been revalued by how much? It has been revalued by 800,000. So now, see what is the difference between this 408 and 300 and 800,000. So 3 zeros omitted. What is the difference? Come on, tell me. 800 minus 408. What is the difference? It is 392. So this is nothing but the revaluation surplus or revaluation gain. Why it's a revaluation gain? Your property value is 408, and when you revalued the property, that means people are ready to pay you 800,000 for this property, which is of worth 408,000, and they are ready to pay you this much. Hello? Hello? Yeah, did you ask me something? Hello? Hello? See, I'm writing it neatly. The property is of 408,000, 3 zeros omitted, and it has got revalued by 800,000. See, did someone say something here? If I'm not wrong. Okay. So now what is the revaluation surplus or gain? See, the property is of this much value and people are ready to pay you this much, but you're not selling it. You have just revalued the property. So the revaluation surplus or gain is $392,000. So 3 zeros omitted, will take 392 in other comprehensive income section. Why will take that in other comprehensive income section? Because it's a non-realizable nature gain. So here it is 392 gain on property revaluation, and your total comprehensive income for the year is this 108, which is the profit for the year and the revaluation gain. Add and you get the total comprehensive income for the year. Okay, so you can just see this adjustment. Any doubts you can ask me, then immediately I'm moving to balance sheet. That means the statement of financial position. I've written it neatly here. Just see this. Okay. Now here we are. Now let's start doing the statement of financial position. So this is what it is. Okay. Now we will start the statement of financial position. All the income statement has been done. Now the property, plant and equipment, which was of $408,000, has got now revalued by $800,000. And let me tell you, now onwards, you should show your property at revalued value. That's a rule. So now property, plant and equipment is of $800,000. Right? Now, like they have given one more thing, plant. Let us see what is that. the plant is also a fixed asset. So now they have plant and machinery at cost 830. Okay, we will take this. And also the plant and machinery is of 222 is the depreciation they are showing. Now I will tell you this plant and machinery, there is some adjustment. Okay, please read this. The plant which was sold had cost $350,000. That means the plant which you are seeing here, how much is the value of that? 830. Out of this, how much worth of plant has been sold? 350. So how much is the plant now left over with you? This is what was the cost at the beginning. Cost at beginning, that is 1/1/2007, and this much plant is sold, okay, during the year. So now you are left over with how much value? So we'll do 830 minus 350 to 480. Okay, so that is here given. $480. Okay, we are in the balance sheet. So there we are. And then accumulated depreciation. So accumulated depreciation also, let's see. So I would just explain you about accumulated depreciation. See here, some plant which you have sold right now, how much worth of plant you have sold? $350,000. And its depreciation is how much? $36,000. So now what we will do is, you always should know one point, that the asset which you are selling, that asset's depreciation should be removed. Okay, because now that asset is not with you and you will not depreciate. So what we'll do is, see, that asset which you have sold, its accumulated depreciation till date, how much depreciation you have made till date. That means at the beginning of the year, the accumulated depreciation account is 222. So I'll make an account here. So this is accumulated depreciation account. I'll make an account, T-shape account. Okay, and see, this is accumulated depreciation is called contra asset account. What do you mean by contra asset account? Contra asset account is such account which reduces the balance, which reduces the value of an asset. So it always shows credit balance. So by that means opposite to asset, by balance brought down. So it is 222. Okay, till date. Now what is the depreciation of that plant? It is 36, correct? Correct? Yes. Please tell me yes or no. It is 36. So I will
Yes,
tell you,
sir.
I will show. Yeah, I will show you the point here. The point here is, where is that question? I will show you that line. You should better understand. So here you see the plant which was sold had cost this much and had carrying amount of this much at first 2007. Depreciation is to be charged like on plant and machinery for 2007. That means this is current year's depreciation. Okay. So now current year's depreciation is how much? Current year's depreciation is 36,000. So what is the journal entry for that? The journal entry is depreciation account debit to accumulated depreciation account. So depreciation to accumulated depreciation, that means every year's depreciation should be added to the accumulated depreciation balance. So now we are going to do the same thing here. We are going to add. So in accumulated depreciation account, I will write by depreciation ledger. By depreciation 36. Correct. Now, see, you have disposed of the asset for how much value? So we will see here. There is some point. Yeah. The plant which was sold had cost this and a carrying amount of this much. So what do you mean by this carrying amount? Carrying amount is today's value. What we are showing in the balance sheet. That means on what date the carrying amount is? First day. That means on first day, the plant which you have purchased long time back, you sold it and its carrying value is this much on that day. Okay. So what is the difference between this and that? So the difference between this carrying amount and the cost of the asset would give you some difference, that is 76. Okay, that would be called as depreciation on disposal. What that will be called? Depreciation on disposal. That means the day when you sold it, how much has the asset got depreciated? Please tell me. How much? 76, of course. Correct or wrong?
Yes,
See,
sir.
yeah, please understand the things very clearly. Plant. Here we are speaking about plant. They have given the balance of the plant and machinery. So plant and machinery are two things. Please understand. And here they have only said about plant. Okay. So whatever may be the value, but plant, some part of the plant is sold, okay, which had a cost of this much and the carrying amount this much. That means till the date the asset is disposed of, the asset has got depreciated by this much amount. That means 350 minus 274, that is 76. Okay, and that comes because this will not be recognized now, so that has to be deducted from this balance. That means now since you have sold the asset, the depreciation of that asset is not to be recognized in this account because that asset is not still going to exist. Okay. And we are not going, it's not going to exist. So we are not going to depreciate in the future. So what we'll do, we will remove it. So we will write it here, depreciation on disposal. So the date till when the asset was sold, it has got depreciated to this tune, and you sold it. Okay. So now since you have already recognized all this in this accumulated depreciation account and this accounts, we will try to correct this and write the exact depreciation. Okay. So 222 plus 36 is 6855. 258 minus 76 is like 182. So this is to balance carry down. So this is your accumulated depreciation now. Okay. So now we will, what we'll do, we will just write it here. This is your asset account and this is your accumulated depreciation. Okay. So that asset we have removed. Okay. From 830 we removed 350. So what we got 480. Now that what you have removed and you have also removed its depreciation. So now this is the leftover plant and this is the current depreciation, current amount in accumulated depreciation account. Now when you deduct this, you get the plant value 298. This is the carrying amount. Okay. Now this is very clear. Next point. Now this is a very important point. Please understand. Okay. See, while doing this question, I explained you something. Now, if you see here, there is some statement here, like consideration for acquisition of Mary and Company 285. That means Mary and Company has been acquired for 285. But what is the actual cost of Mary and Company? So net assets of Mary and Company were purchased on 3rd March 2007. Assets were valued as follows. So you can see the value of the asset as 265. That is the value of Mary and Company's assets. So 265 worth of Mary Company's assets, and you paid 285 for that. So can I say you paid extra how much? 20. Can I say this is goodwill? Whatever the extra
Yes,
you
sir.
paid for acquiring that company is goodwill? Yes. So some excess amount which you paid to acquire some companies, net assets. See, what do you mean by net assets? Total of assets minus liabilities. Total of assets minus liabilities called net assets. Okay. You should understand this terminology. Net asset is nothing but equal to total of assets minus total of liabilities. That is equal to equity. And equity and net assets mean the same. Okay. So that means I already gave you a very good example of a car. This is a car and you bought it for, the car value is 10 lakhs and you paid 2 lakhs as your contribution. 8 lakhs you took a loan. So 2 lakhs is your equity, 8 lakhs is your debt. And what is the net asset value of this car? It is 2 lakhs. How? 10 lakhs minus 8 lakhs. Okay. Because you have claim on that car of 2 lakhs, $200,000. Okay. Not $800,000. That's a loan you have taken, you have borrowed. Now, so for 265, you paid 285. So goodwill is 20. We will show that goodwill in the balance sheet because it's an intangible asset and we showed here. Okay, this is the goodwill. And now we will see whether we have done some investments. Let us see. So equity investments, they have given in the question how much did they give, or like they have given some adjustment. Let us see. Yeah, so some investments you have, some equity investments also you have. Okay, so like how much is the investment? 231, that you have to show. Why? Because inventory you have already added. Okay, this inventory you have already added to your purchases, and this equity investments what you purchased is an asset for you. So we will write that here in the balance sheet. So that inventory I've already shown in cost of sales as a purchase, and equity investments is an investment. So it has to be shown in the asset side of balance sheet. And we are showing that here. Equity investments 231. Okay. And this inventory they have given in additional information as 220. That's closing inventory. Receivable is given. And you remember the prepaid expenses. I already told you that there was some adjustment regarding prepaid expenses, prepayments. Here I already explained you that. I'll show you once again, don't worry. This one, sundry expenses 6, that means we calculated per month wise and we took only for 9 months, so it happened to be 6,000. You remember that? Yes or no, all of you? In the previous video. Hello. Here you can see sundry expenses include $9,000.
Yes, sir.
Yeah, 9,000 divided by 12 is how much? It's like 750, and you paid for for 8 months. So that happens to be 6,000. So we'll take 6, 3 zeros omitted. So 6 is here. And that is a prepaid expense, something which you have made the payment already. It's an asset for you. Now you will enjoy the benefits. Done. And then cash and cash equivalents is given directly in the balance sheet of 126. Now you have to add this all. 800 plus 298 plus 20 plus 231 and 531. You get total of assets. That is 1880. Okay. Now have a look through this. We'll go for the liabilities. Okay. Let's now do the equity thing. So first we will make an account of like statement of changes in equity. So this is Wilson Company statement of changes in equity for the year ended 31st December 2007. Share capital, share premium, retained earnings, general reserve, revaluation surplus. All this is a part of equity. And you have the opening balance of 450 given to you in the question. You can scroll up and see retained earnings. But I'll just show you at once. Retained earnings balance is given. General reserve balance is given. So all this total to 863. I'll show you the balances. Okay. 450, 282 and 171. So 450 and then like 171 and then sorry 242 it is. Okay. So these three balances I've written. And now I'll explain you some adjustment. You should try and understand. See, there is something here. Yeah. See, proceeds from issue of 100,000 ordinary shares. So company has sold some 100,000 stocks or shares and they got 120 for that. What is the actual face value of each stock? If you see the balance sheet, 50 cent is the value of each stock. So in actuality, how much you should get and how much you got, we will see. So $100,000 into 0.50 would be $50,000. This is what you should get. Okay, but you got $120,000. You got $70,000 extra. The difference, I'll write it here. That difference, what you got extra is nothing but premium. That's called share premium. Okay. So this share, because see, you should get how much? $50,000 as per the face value, but you got $120,000. So you got extra $70,000. That is what is not, because this information is in suspense account. That means we don't know some details. So for 50,000 you got 120,000, 70,000 is the premium. We will write that premium here. That means you issued some additional shares and the additional shares whatever you issued should be at 50 cents. Okay. For 50 cents it should be like $50,000, but you got $70,000. So $50,000 in share capital, $70,000 in share premium, and this both add up and you get 120. And you can see 450 plus 50 is 570 is here. This is done. And now this dividends is given to you in the income in the trial balance. That company has paid a dividend, ordinary dividend of 15. You can see here. Ordinary dividend 15. Okay. So this 15 has to be deducted from the retained earnings account. It has to be subtracted from retained earnings account. That is the rule. So we will subtract the dividends from the retained earnings account. We subtracted, and then this year's profit we have like we should add that to retained earnings account, and there is an adjustment in your so this is the current year's profit. I'll show you. So your current year's profit happens to be 108. We have added that, and also this 392, it will go in the revaluation surplus account. You can see this 392 has gone into revaluation surplus account. Okay, so this and this both add up, make 500. Now only I have to explain you this reserve given in the question. So that is in the additional information. A transfer to general reserve is of 16,000. So you will deduct this from retained earnings account and you will write that in the general reserve account. So because you are transferring some amount from retained earnings, you have the authority to transfer from retained earnings only. So from retained earnings we deducted and we add it to general reserve. Okay. And then you have this totals 570, 319, 187, 392, and all these figures you should take directly and write in the equity section. Sorry, balance sheet. So 570, 392, 187, 319. Okay, total to 1468, which we have already found out. Loan stock is given to you in the question itself in trial balance. If you scroll up, you'll see 200. Trade payable is given, and this is accrued expenses, which is nothing but a combination of I'll explain you. So that is outstanding expenses. So here the accrued expenses, this is one. The management wish to provide for loan interest due audit fees. So audit fees for loan interest, already you know about the loan interest. They have given in the question 10% loan note secured 200. So 200's 10% is 20. 200's, I will write it here. I got done a lot of work. 200's 10% is 20, and some information given to you. Loan interest, loan note interest 10. That means this has been paid. Okay, this has been paid, and that means you are supposed to pay 20 out. So since you are supposed to pay 20, 10 you have already paid. Okay, and 10 is outstanding. So that 10 outstanding is making it 20 completely. So this 10 outstanding should be written in the liabilities as accrued expenses, outstanding expenses. So that we will take as 10. Here we are. So we take 10, we take 3, and we take one more thing. 3, or like audit fees is 4, I think. One more thing you remember, like there was like this 3 light and heating expenses, which was outstanding. Outstanding invoice of light and heat. You can see the adjustment number 1. So light and heat also includes 20,000, but here light and heat does not include an invoice of 3,000. So does not include an invoice of 3,000 means 3,000 is outstanding. We will add that. So all this makes 17, and when you add this two, you get 212, and this is the total of balance sheet. Okay, so just see this. Any doubts you can ask me. बहुत हो गया घर में. I hope all of you are seeing this. If you have got any doubts, you can raise those doubts. Hello. If you've got any doubts, you can raise. Meanwhile, I'm giving you one homework. So all of you should solve this question for tomorrow. I'm sending the homework to you. So solve that question tomorrow. It's a like statement question. Okay, so next chapter we are going to start on Monday. The next chapter we are going to start on Monday, which is we're going to do this tangible non-current assets. We're going to start from tangible non-current assets. Okay. We'll do tangible, intangible, impairment. These three chapters is my target now. Next target. So like we'll take the class on Monday as usual, and like just a second, my file is getting downloaded. Just wait for a second. I'm sending the questions to you. Just a second on your WhatsApp. It got downloaded. If you're not getting these questions, you tell me Monday. I'll solve it for you on board. Okay, I'll solve it for you in the class. It's a good question I'm giving you. So do this. I'm not sharing the solution with you. If you have done, you can ask me for solution. I can provide you. There may be some issue you may like find with this question about some income tax or something. So if you can do it, okay. If you can't, Monday we will solve it. Don't worry, okay. Ravi, you have already solved in the class, so no need for you. Okay, I have sent the questions to you. Just see your WhatsApp. Check your WhatsApp, all of you. Check your WhatsApp. Did you get Abhishek? Did you get the question? Hello.
Yes, sir.
Yeah, and Bishara, did you get the question? Hello. Hello. Okay, then try this question at home. Okay, this is a homework. Monday we will see. Like if you've got any doubts, we'll try to clarify. First, we'll take the class and then we'll continue with this question. Okay. Thank you all of you. Bye bye.
Thank
This
you, sir.
chapter is done. Yeah.